I want to start off with a number. From 1948 to 2025, productivity in the United States grew 90%. Hourly compensation grew 33%. That gap did not happen by accident, and AI is not going to close it. I believe it's going to make it worse, and I think I can prove that. My name is Ernest Provo. I have spent the last 16 years inside enterprise organizations, financial services, financial tech, manufacturing, healthcare, government, and I've seen how technology is actually adopted versus how the press and Silicon Valley say it gets adopted. Today, I'm going to present my theorem. So, not necessarily a take, a lot of evidence, a lot of details, not an opinion piece, a falsifiable theorem with specific predictions and defined timeframes that you can hold me accountable to, and we can watch this happen together. I'm going to call this the Refinery Paradox. It's part of a lot of content that I'm working on. I have a book I'm putting together about this from a practitioner's point of view. So here it is in one sentence. The technology that promises to democratize intelligence and distribute prosperity is, by the operating logic of the system it is being deployed into, concentrating both. Not because the technology is flawed, not because individual executives are malicious, but because the system is working exactly as it is designed. I'm going to address head on 5 falsifiable predictions with dates attached to them for us. Let's go. So here's the foundational argument. AI is an accelerant, not a shift. Hear that again if you need to. 2 camps dominate the AI discourse en masse right now. Camp 1 is the techno optimists, right? The AI folks who believe that everything creates broad-based abundance, rising tide lifts all boats sort of thing. Post new jobs replace old ones. History vindicates them. Camp 2, there's the post-labor theorist. Automation destroys work, but we need universal basic income or worker ownership structures that redistribute the gains. Both camps share one critical blind spot to me. This is how I'll address it, right? I believe they see it as a paradigm shift. What I'm going to talk about is that this is not a paradigm shift where they see it as something capable of restructuring economic relationships from the ground up. I don't see it as that. The operational evidence says something completely different, right? So the central claim for me is that AI is not a paradigm shift here. It is a paradigm accelerant. It takes the existing operating logic of enterprise capitalism and it's going to run faster. So what is that operating logic, right? Well, it's been stable for approximately 50 years or more. Maximize profit, minimize expenses, optimize efficiency, compound those gains quarter over quarter, year over year. Every Fortune 500 boardroom runs this cycle. Every executive leadership conversation centers around the same questions. How do we use available technology to capture more margin while reducing costs? AI enters the cycle as a higher velocity tool for the same objective. The system does not change, it tightens. So if AI were truly restructuring economic relationships, you would expect capital to flow toward capability. So let's look at where capital is actually flowing, right? Hyperscalers, Microsoft, Alphabet, Amazon, Meta, Oracle, committed already between $660 and $690 billion in capital expenditure for 2026 alone, nearly doubling 2025 levels. OpenAI is only at $20 billion annual recurring revenue. Anthropic is approaching $9 billion run rate. The 2 most successful AI capability companies in history, together they've generated only 3% of the infrastructure investment being deployed by hyperscalers. Capital is not chasing AI capability. Capital is chasing infrastructure control. That is the first signal of the theorem here. 71% of organizations report regular use of generative AI. More than 80% report zero measurable impact to enterprise level EBITDA. The 95% failure rate story that we've all become very familiar with. of enterprise AI pilots is not a technology failure. It wasn't and never has been. It's an organizational capacity failure. Businesses are trying to layer 21st century compute onto 20th century data architectures, workflows, and institutional structures that were never designed for this. And here's the part that matters to my theorem. Specialized vendor tools succeed at 67% versus 33% for internal builds. Again, 67% versus 33%. Companies are externalizing AI capability to vendors rather than building it internally because it makes sense, because that's how business has worked. This is the same risk externalization pattern that governs every other enterprise decision. The system does not change. Again, it tightens. Even if AGI arrives tomorrow, and this might be my most, counter popular opinion. Even if AGI arrives tomorrow, most enterprises could not adopt it. Not that they wouldn't, but they could not adopt it. Not because the software is insufficient, but because the data architectures are immature, the workflows are undocumented, the institutional context is missing, and the risk tolerance is just absolutely too low. Organizational capacity moves at generational speed. Software capability moves at exponential speed. The firms capturing value in the gap are not deploying AI internally. They are selling infrastructure that everyone else depends on. So most people who use the oil boom comparison are making a metaphor. I'm going to make a structural argument about this. During the original oil rush of the 19th century, thousands of independent producers, wildcatters, and speculators entered the market. The press coverage of that era, if we pulled up clips today, looked a lot like press coverage of AI today. New fortunes were being made overnight. Democratic access to a new resource. The generational outcome was not distributed prosperity, though. It was Standard Oil. John D. Rockefeller did not win by discovering oil, right? He won by controlling the refining process, transportation, and distribution. The discoverers were absorbed or eliminated entirely. The infrastructure owners captured everything. This is my refinery paradox. Thousands of AI startups, consulting firms, and LLCs are speculating on capability just like the wildcatters. But capital is flowing to refining infrastructure. Three interlocking advantages are concentrating, right? There's the computational capacity. Hyperscalers are controlling the physical infrastructure that every AI application depends on. There is no AI without data centers. There's the energy density problem. The project Stargate, if you're familiar, if you've heard about it, targets 7 gigawatts of capacity across 5 regional hubs. Meta is scaling a Louisiana facility towards 5 gigawatts itself. Microsoft reports $80 billion in Azure backlog that cannot be fulfilled, not because there is no demand, but because there is not enough power yet. The bottleneck is energy, not software, not talent, energy. So capital reserves. These firms also have enough capital to expand into adjacent regulated industries through the same quarterly logic that drives their core business. At large financial services companies, they don't need to leap into unregulated markets overnight. It just looks like adjacent verticals that serve its core business: insurance, fleet management, and real estate financing. This is where I say, after the 3 areas of advantage become obvious, you have the adjacent expansion of large companies or companies that have capital to move into adjacent. This is what I have watched from the inside. This is what I have been part of in solutioning. Every step is a board approved adjacency. Every step is individually rational and individually defensible because of the process it takes to move this stuff in corporate America or global corporate. And over generational Time is the only way that these firms actually implement these changes. A firm has quietly become a conglomerate over the time it has by touching multiple industries and doing that over time, not because they took technology and just became a completely different monster. There's no grand strategy from 40 years ago to getting where you are. I mean, you're talking about a ton of quarters in 40 years, a ton of turnover, a ton of different people who worked at that company, because every quarter the same question is going to still be asked during meetings. What is the next goal and where is the next margin? When a firm achieves simultaneous dominance in data assets, analytical infrastructure, energy access, and capital reserves, the expansion becomes inevitable. Regulatory response from that will lag by at least one full market cycle. Most people think from the antitrust breakup of Standard Oil in 1911 that this reversed concentration, right? It did not. Prosecutors focused on kerosene market shares during this breakup from Standard Oil, while the world was transitioning to gasoline for the Model T. The dissolution tripled Rockefeller's wealth as the baby oils proved more valuable independently than the parent had been. Regulation did not reverse concentration, it restructured it. So write that down, because this is exactly what is going to happen in AI infrastructure regulation. For me, this talks about the distributed accountability mechanism, how the gap is supposed to be manufactured, or how it is manufactured. Productivity has grown 90% since we talked about this originally. Compensation has grown 33% over the same 77-year period. Most economists treat this as a market failure, and they say that this is policy oversight at its finest. I'm going to argue that it's neither. Not because I have a moral obligation or I believe that this is the right way, but I believe this is reality happening in front of us, right? It is intended for the output of the enterprise operating system function. It is the intended output of the enterprise operating system functioning correctly from the capital's perspective. And the mechanism that produces it is something I call the distributed accountability. How this works is, let's imagine this from one example, right? So a corporation engages an HR consulting firm to provide compensation benchmarking, right? The firm surveys industry peers, all of whom use the same consulting firm running similar methodologies. The benchmark reflects that everyone else is paying this number, or what everyone else is paying, which reflects what their consultants told them is the market rate. This results in a closed loop, right? The company leadership points to the consultant, we pay the market rate. The consultant points to the methodology, we reflect the market, right? Nobody made a suppressive decision. The system produced a suppressive outcome through distributed accountability. I think this layers across every operational dimension that I've seen, right? The company does not decide to offshore support. A process is talking about optimizing vendor recommendations or recommends it in general based on cost modeling that we've run through. The company does not decide to replace a team with AI. Technology partners' return on investment analysis demonstrates the efficiency gains, and it's undeniable. The finance team and accounting model shows that long-term liability exposure of compounding 3% annual increases across headcount will be problematic. Each decision is individually rational, right? Individually defensible, individually someone else's recommendation for the company. The cumulative effect is that 90 to 33 gap, but no single actor owns that. I think this is why it matters for AI specifically, right? Post-labor theorists propose that corporations should voluntarily create ownership structures for displaced workers. Universal basic income by the same folks should be funded by AI productivity gains. They believe that worker cooperative should be converted, that equity sharing with displaced labor is the goal. All of these proposals require corporations to voluntarily act against the operating logic that produced that 90 to 33% gap. But the same distributed accountability mechanism that produce the gap ensures voluntary action just cannot happen. The system is not set up to make those decisions, even if an individual executive wanted to, right? I have been in rooms several times where individual executives wanted to make some serious changes, but the system is not built to, right? It's built to support the idea of how the gap really becomes manufactured from this view on your screen now, right? So it's an infinite loop, right? HR firms get surveyed, peers reuse the same consultants, benchmarks become reflected, and the company pay stays virtually the same or has a very minimal increase over time, right? So there's a natural resistance to how it becomes built, right? And this leads to what I think is important for the bifurcation prediction and the scientific underpinning that I'll talk about here, right? If energy, not labor, is the only physical productive input to an economy, the scientific underpinning is that the energy organization frameworks may have a point. And labor functions as a supervisory and organizational input, right? The wages are not payments for physical contribution, they are shared rents from surplus generated by energy applied through organizational structures. As AI replaces human supervisory functions with digital organizational inputs, that bargaining claim to those rents naturally diminishes. There would be no incentive for the business or the or companies to help the displaced labor reorg or find a different way to be dealt with because the physical basis of the claim has been eroded. This is the structural observation of what AI actually replaces, right? And that leads me into the bifurcation issue that I want to show again here, right? So this is undeniably happening in front of you and I right now. There are many people who have already noticed it from the entry level class of workers, right? And so if you look at the screen here, the post labor ownership transition is not uniformly failing. It is succeeding with enclaves of existing capital proximity and accelerating extraction everywhere else. This is the bifurcation. Okay. Who benefits, right? Exactly. If you ask me now, who benefits from the start thinking like an owner advice? Well, a person with discretionary income, right? If you have money to invest, if you're a person in a country with functioning institutional framework, if you're a person whose bank offers sophisticated investment products, maybe somebody who's super financially literate or socially capable, or you have social capital and the proximity to capital markets and people who can help. But this is not America broadly, right? This is a specific already advantaged slice of America. So that advice is not wrong, but the access to what you're talking about to execute it is not distributed. It is very concentrated. The emerging data on this is showing that workers aged 22 to 25 are exposed in this AI occupation onslaught, right? Experiencing already measurable a 13% relative decline in employment for workers between 20 to 25. Prime age experienced workers remain stable or show marginal growth. According to Ireland's Department of Finance, they have a documented case of a 20% drop in youth employment between 23 and 25 alone of 2020, while prime age roles for folks 35 and older grew 12%. The Dallas Federal Reserve found that AI substitutes for entry level workers, but augments experienced workers tremendously. Because AI replicates codified textbook knowledge, what you learn in school, it cannot replicate tacit knowledge, which you learn from 10 years of doing on the job. The experience premium is growing and the entry point is narrowing tremendously. In the enclave class, experienced practitioners who translate AI capability into measurable productivity gains within existing business logic, those are the people who really gain, right? Capital holders positioned to capture energy rents from AI driven output are the entities controlling the refining structure that we've discussed already. The extracted class that we kind of talked about here. So the entry level workers whose codifiable skills are automated now become communities without existing, assets to really access any of the institutional infrastructure that we've talked about several times. Populations whose historical exclusion from these capital markets ensures that they cannot participate in whatever narrow ownership transition is bound to occur in the short term. So I think there are 6 objections that I have that we can talk about here. The wall between these two classes really has become an issue of it's not built on policy. It's built on the same vendor mediated, quarterly optimized, risk externalized decision making process that produces productivity compensation gaps across the world. The same corporate logic that prevents broad ownership structures from forming ensures narrow ownership structures from readily becoming available. Race, geography, class, these are not incidental to the bifurcation. They are structural determinants of which side of the wall that you start on. So, objection 1, right, is that corporate hiring initiatives prove the reversal, right? IBM announced tripling Gen Z hiring. The response from me is that that's just marketing arbitrage. I don't see any structural reversal for IBM, and I think we all know why. There's several reasons IBM has not been a market leader for the last 20 years. This is a market test to whether it moves the stock. If it doesn't, then I think that's capital signaling. The theorem has a lot of weight to it, and it proves that this is maybe more of the exception that proves the rule, right? Objection 2, regulatory enforcement is addressing concentration. I believe the DOJ, when they forced divestitures in the United Health merger, the response from me would be that structural remedies getting imposed after mergers do not prevent concentration. I mean, it's just well-resourced firms that have acquisitions to avoid forced divestiture. The regulatory wins reflect selection bias against less capable acquirers, not systemic enforcement. So this is the Standard Oil example confirming this, right? Dissolution tripled the monopolist's wealth. Objection 3, worker cooperatives offer viable alternatives. The 1042 rollover, which lets owners defer capital gains by selling to employees, is real and it does work. It works for small to mid-sized firms with retiring owners who already have existing equity. It does not reach the hyperscaler layer where refining infrastructure actually resides. So Amazon is not converting into a cooperative. The US economy capital to labor ratio is 262,000 per worker. The workforce lacks collateral to finance high capital transitions. Objection 4 for me would be that data is not rivalrous, as I've kind of put here. That meaning it's not, unlike oil, data can be copied and shared at a near zero marginal cost, right? So the response for me is that the theorem here does not claim that data would be rivalrous. It claims that refining capacity is the rivalrous situation. The computing infrastructure, energy density, analytical capability are scarce, capital intensive, and concentrating. The non-rivalrous nature of data actually accelerates concentration. Whoever controls the refining layer will process unlimited inputs while competitors cannot. I think it's human agency. The theorem is deterministic and ignores the human agency. My response to that is that my theorem does not claim change is impossible. It claims that change would require cataclysmic disruption, is what I would say. And it's been running this way for the last 50 years. Quarterly optimization, distributed accountability, risk externalization would all need to be replaced simultaneously in business schools, in boardrooms and consulting firms, and in investor expectations. That's not a policy shift. That's a human civilization shift. So foundational disruption, your only way to get there. Objection 6 that I could see or predict is that agentic AI is already being scaled out, and people think that this is going to be the next big thing. My response to this is that scaling AI in just one function within a business existing logic is exactly why my theorem works, and it predicts that. That's not transformation. That's the acceleration. So the paradigm shift that we talked about at the very beginning. It's not a paradigm shift. It's a paradigm acceleration. The measure is whether it creates new value broadly or captures margin narrowly. the 80% zero EBITDA impact that we talked about and the reduction of all enterprise AI value to productivity gains or expense reduction confirms this. Okay. My 5 falsifiable predictions that you're going to want to hear about. Here they are. Prediction 1: any firm who's achieving simultaneous dominance in data assets, analytical infrastructure, energy access, and capital reserves will expand into adjacent regulated industries within 3 to 5 years, and regulatory response will lag by at least one full market cycle. Prediction 2: a measurably bifurcated economy will exist for sure by 2030. Post labor ownership transition succeeding within the top wealth quintile and tech corridors and high income metros, accelerated extraction everywhere else. So measurable along racial, geographical, and class lines. Prediction 3: the primary enterprise beneficiaries will be mid career and senior practitioners who translate AI capability into measurable productivity gains, not the entry level workers, not alternative economic structures, not populations targeted by post labor proposals. Prediction 4: enterprise AI deployments will continue to reduce to just the 2 P&L outputs for your CFO and your other financial leaders at these companies. What man hours have been recovered and what expenses have been reduced. AI is not going to generate new categories of enterprise economic value. It will compound the existing optimization cycles at a higher velocity. Prediction 5: the majority of independent AI startups, consultancies, and LLCs formed between 2022 and 2026 will be acquired, absorbed, eliminated, or otherwise obsolete within a generational time frame as the refining infrastructure owners consolidate. So the refining paradox is this, right? The technology that promises to democratize intelligence and prosperity is, by the operating logic of the system it is deployed into, concentrating both. Okay. Not because the technology is flawed, not because individual actors are malicious, but because the operating system of enterprise capitalism, which is quarterly optimizations, distributed accountability, risk externalization, and capital concentration toward infrastructure control. So that verticality of running your business converts every input, no matter how transformative it is or the technological impressiveness. It transforms all of that into potential, or its potential into the same outputs, right? Margin captured by those who control the refining process. So the lesson of this that I would say, data is certainly the new oil, but the lesson of oil was never about the resource itself. It was about who controls refineries. The discoverers speculated it. The refiners consolidated, stratified by race, geography, and class, bore the extraction costs while receiving the least benefit. AI is following the same trajectory. So I'm not telling you to opt out of the system. I'm telling you how to understand it. Position yourself at the refining layer where value concentrates. Develop the tacit knowledge that AI can replace, that they cannot replicate. Judgment, governance, architecture, translation between capability and organizational reality. Start to advocate for the structural interventions and represent the only historical viable mechanisms for broadening participation in these concentrated economies. Cooperative conversion, energy rent distribution, regulatory frameworks that address infrastructure monopoly rather than the last cycle's market shares. The paradox is not that AI fails to deliver on its promise. The paradox is that it delivers to the refiners. I am publishing this whole theorem on Substack today, the Refinery Report. The link will be in the bio. That is where the academic citations will also be attributed. The detailed mechanism breakdowns and the falsifiability criteria lie for any other practitioners and researchers in my audience or who are viewing this. This is the foundation, like I said, to the book that I'm putting together. I'm looking to get that out by this year. If this landed with you, please subscribe, share it with somebody who needs the honest version of the conversation, and drop your counter arguments in the comments. I'd love to hear what your thoughts are. Again, I built the theorem to survive them. Let's see where we go from here.